Welcome to The Explainer. Today, we're stepping right into the ring for what is, honestly, the most famous heavyweight title fight in modern finance. It's active versus passive investing. Now, this is the debate that has literally raged across trading floors and academic halls for decades. In one corner, we've got highly compensated professionals aggressively trying to outsmart the market. And in the other corner, we've got the boring, totally unopinionated index funds that are simply trying to match the market. While groups like SPIVA have tracked this rivalry on a global scale for years, today we're getting incredibly granular. We're going to dive into a massive, rigorous empirical analysis focused specifically on the German equity market. The data we are about to look at strips away all the marketing spin, and it's going to show us exactly what happens to an investor's money over a decade.
Okay, let's dive into the tail of the tape for this explainer. First, the great investment debate. Second, testing the German market. Third, the illusion of outperformance. Fourth, the costly reality check. And finally, the final verdict. Section 1, the great investment debate. To really appreciate the data we're going to look at, we have to understand the stakes of this classic divide. On the active management side, you have managers explicitly aiming for alpha through dynamic, day-to-day stock picking. Then on the passive management side, you're just accepting beta by broadly tracking an index. It's a debate so massive that entities like S&P Dow Jones Indices have literally built entire research divisions around it just to figure out who is actually winning. Now, the passive approach is, of course, deeply rooted in Eugene Fama's famous efficient market hypothesis. The idea here is that since algorithms and high-frequency traders price breaking news into securities almost instantly, paying an active manager to go find hidden gems is kind of a fool's errand. You're basically hunting for inefficiencies that the collective wisdom of the market has already completely neutralized. All right, Section 2, testing the German market. But, theories always need to be tested against reality. In a really comprehensive study from the Journal of Financial Risk Management, researchers went straight to BaFin, that's the German Federal Financial Supervisory Authority. From an initial list of over 13,000 funds, they rigorously filtered the data all the way down to a very precise, high-quality sample size of exactly 194 actively managed single equity funds. And here's the kicker. To prevent short-term luck from skewing the results, these 194 funds were tracked over a full 10-year investment period, specifically from 2007 to 2017. 10 years is absolutely crucial because it's long enough to cover totally different market cycles, importantly including the absolute chaos of the 2008 financial crisis, and then the bull market that followed. This duration effectively separates the lucky stock pickers from the truly skilled ones. But how do you actually judge if these active funds succeeded? A lot of times, studies just use a basic index, like the DAX. But let's be real, those don't fully capture the complex reality of a diversified market. So, to make this a truly fair fight, the researchers constructed a really robust, customized passive benchmark combining these 4 specific ETFs. By blending the MSCI World Index with European value, growth, and dividend funds, they created a passive opponent that accurately reflected the global, multi-factor playing field that these German active funds were actually operating in. Moving on to Section 3, the illusion of outperformance. So the bell rings, and wow, one contender takes a really surprising lead. When we look at the annualized arithmetic mean return over that decade, the active funds actually outperformed. They generated a 5.47% gross return against the passive benchmark's 4.90%. They found a gap. They beat the market by over 0.5% per year on average. So, strictly speaking, stock picking skill definitely exists. So, what does this all mean? Do active funds win the fight? If active managers are generating a 5.47% gross return, are they the undisputed champions of the financial world? Well, let's look at Section 4, the costly reality check. Unfortunately for active managers, here is the harsh reality. Nobody on Wall Street or in Frankfurt works for free. Yes, they absolutely exhibited genuine skill by beating the market by 0.57% gross. But they charged a total expense ratio of roughly 1.20%. Subtract that 1.20% cost, and the active funds immediately fall straight into the red. They were skilled enough to beat the market, for sure, but they just weren't skilled enough to cover their own expensive salaries, their marketing, and their trading costs. The net result for the actual investor is total underperformance. And remarkably, it gets worse. You see, this data hides a massive trap known as survivorship bias. In the mutual fund industry, if an active fund performs terribly, the management company doesn't just leave it there. They will quietly shut it down or merge it out of existence just to hide the embarrassing track record. Because all those losing funds are completely erased from the historical database, survivorship bias artificially inflates the risk-adjusted yearly returns. The researchers actually estimate this inflation is somewhere between 0.4% and 0.6%. Meaning, if we went back in time and included all the failed, closed-down active funds from the German market, the active manager's overall track record would drop by nearly 0.5% annually. That makes their underperformance against the passive index even more dramatic. Which brings us to Section 5, the final verdict. We've seen the gross returns, we've applied the heavy burden of fees, and we've accounted for the invisible graveyard of closed funds. When the researchers conducted their ultimate cross-sectional linear regression analysis over this entire 10-year period, out of all 194 actively managed single equity funds available over a full decade, exactly one single fund generated a statistically significant alpha. To quote the study's authors directly regarding their empirical findings, the null hypothesis cannot be rejected, indicating that active funds in general do not create significant value in form of alpha. While a tiny fraction of managers might have hot hands for a brief little period, as a whole, the active management industry simply fails to justify its existence from a purely mathematical value creation standpoint over the long term. The outcome of our title fight is totally decisive. The boring passive index fund is the undisputed champion. And for everyday retail investors, the takeaway here is incredibly powerful. You do not need to stress over finding the next genius portfolio manager. The math clearly shows that skipping the expensive active managers, avoiding those 1.2% fees, and simply buying the broad passive market is the winning strategy. It's a completely uncostly, highly efficient way to capture wealth generation without bleeding your returns out in administrative fees. Which brings us to a final critical look at your own retirement portfolio. Take a look at the funds you hold right now. When you see that expense ratio line item, are you actually paying for market-beating performance? Or are you just paying fees to a manager who is secretly losing to a simple index fund? Thank you so much for joining me for this explainer, and keep asking the tough questions about your investments.